Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The bearish bow tie formed back in early July has been the second biggest strategic event of this market in recent times, first being obviously the large diamond pattern. This is the bow tie. It is made up of the following: the short moving average, currently 222 and a quarter, the medium moving average, currently 220.65, and the long moving average, currently 226.15, crossing over more or less simultaneously. I suspect this might have triggered the big move down in mid-July. Going back first up to the bow tie formation itself, there are generally two expectations. The first is that between 15 to 20 sessions after the crossover, we should have seen a move in the direction of the bow tie. That would have been between the 29th of July and the 5th of August. Secondly, the market would move in the direction of the second bow. That is the one after the crossover. Hence a bearish crossover of moving averages and a bearish move. Well, after all that, we did have a combined key reversal down and bearish engulfing pattern on the 1st of August, a good looking one as well. However, that petered out 2 days later with a combined bullish engulfing pattern and bullish opening white Mariposa. This rendered the bearish bow tie formation a failure. Following on from this turn higher, we've seen prices break up through the top of what had been a prospective diamond pattern by pushing up over the February to August downtrend, currently at 222.70, which also acted as the upper downtrend of the diamond pattern. However, after reaching up to the high of 2012 at 241.05 and just short of the high of November 2011 at 243.40, well, prices peaked out and fell away again, though in a much more considered manner than when they rose up there in the first place. 3 weeks ago, the market slipped down below the downtrend line, the broken downtrend line, once again. Since then, prices have been supported by the congestion from July and August, mainly in the 207.35 to 217.5 area. Now, the next part is a little bit controversial. You see, there is the possibility that the action from March or even April could be seen, and I am stretching the boundaries here, could be seen as a possible reverse head and shoulder in construction. I am not very happy about saying this, but it just might be seen as such, with either a possible split first shoulder or a pattern masquerading as a first shoulder before it actually forms a first shoulder. I have not marked down this pattern because there really isn't enough data to accommodate it, but it's something to look at closely right now, as we may be forming a second shoulder. London coffee. Until July, the market had been unable to penetrate the support area underneath that stretched from the 2004 level all the way down to the 1935 area. However, it was in July that the market tried lower and was reasonably successful. I say reasonably because the dip achieved its primary target for the action between March and June, being a sideways rectangle pattern. However, one could also look at the action since March being more like a shallowly descending wedge pattern. But for what was achieved, a rectangle will do. Yet for all that being said, one can look at the dip in July as a false break from the shallow descending wedge pattern rectangle. For a little while, the market move back up was limited by our old friend the 2004 level, the top of the previously mentioned congestion area that became resistance, but eventually became support at the turn into August. Since then, prices turned significantly higher through a number of resistances and peaked at the end of August by reaching the secondary harder to reach target X1 in the 22.95 area for the rectangle and falling away lower the very next day. The question now is whether the whole action since about early August to date, whether it is a type of head and shoulders pattern. The market is still above the neckline. You can call it a neckline. That's currently at 21.78. But today's action seems to be a serious attempt lower. The only other option would be to regard the action since the start of August as a possible large bull flag, having formed the flagpole and now forming the flag. But right now that seems even more remote. It all depends on whether the market gets down to the neckline and what it does there should it manage to get down there. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.